just understanding like there's a great high water line where you want to be, and then there's the where you can't go below personally. And that's one way of thinking about risk. And for some people, they're very adverse to debt risk. Like they just don't like debt. It's a personal preference. But if that is your preference and that's what's informing your risk basis, then that's going to color the way that you look at an equity partner because you're going to be way more into that than you would debt. It's going to skew your perception and not wrong, just facts.
What do operators need to know before raising capital and what do operators need to know before raising capital and what should they have in place before talking to investors?
What you need to know before you start raising capital is that there are many, many different places to go get that capital. And so when we talk about capital, this is the money that you're getting from other places outside of revenue to grow the business, right? So you got the profitability of the company, great, but maybe that's not enough to go open a second, third, fourth unit or to buy, equipment for manufacturing or to launch a franchise program, whatever. And so when you think about capital, you're looking outside the company to go find ways to pull in money. And there are three things you should be thinking about. And the first is, what stage am I at? If you are too early, certain types of capital are going to be harder for you to get a handle on. Two, how much control do you want to maintain as a founder, owner, operator? And three, what is your risk tolerance? So when you are evaluating capital through that lens, you should be looking at all of your options, which include debt and its many forms, including options like crowd raising debt, including options like friends and family debt that you design, including, perhaps an SBA loan, maybe even a traditional note. Who knows, right? I think then you start thinking about equity, right? Because if you're at that point that you need some serious capital and you've proven the concept out and you're willing to give away points in the company in exchange for that money, you're looking at probably potentially a later stage in the company's growth. But nonetheless, if you're in that seat, again, looking at friends and family, looking at a crowd raise, looking at potentially venture capital, depending on how far
Yeah.
along you are. If you're CPG, especially, way more venture capital in that space. Um, Sometimes even early stage private equity, like we do at Full Course. But there's a range of options out there that, you may not be thinking of: family offices, high net worth individuals, angel investors. And really thinking through that lens of where am I in the company's growth trajectory? How much do I actually need right now? What am I willing to do or not do? And how much am I willing to swallow in risk? Because to me, that's such a personal thing for a founder. I know founders who are good leveraging their house, and I know other founders who are like, absolutely not, never. Like, that's the one thing I won't touch, right? So you can see just with that example of someone's home that like how personal this is. Like
Yeah.
you can't treat it in a like it's standard or rote in a decision or say, okay, if then be. Like it's just so highly personal. And the last thing I'll say on this is, don't miss the opportunities for free money. There are gifts, grants, both public and private. There are fellowships, there are scholarships. It takes time and energy to find them, apply for them, and get them. And sometimes the check sizes are 100K, sometimes they're 10. But if you're early and you're scrappy, that may be an option for you too. Now, listen, don't build your company's future depending on that. But it's nice to have that extra little bump. And a lot of times that money comes with help, comes with programs, comes with additional support. And so especially if you're early stage, that may be a capital source for you as well.
I think something you said in there that was really powerful is how much do I need right now? And I
Mm.
think so often people are thinking, this is my chance, right? Like the initial raise is the biggest raise. And I think that's just, you know,
No,
unfortunate.
I I I I think about it this way. I used to teach a course and on starting your first business. It wasn't specifically about restaurants, but I used to say to people who were transitioning out of full-time corporate careers that wanted to go start a business, do you know what your ramen noodles number is? And that is the number that you need to live on as a human being to meet your obligations, whether you have a rent payment or a home payment. And if you have to get right with the fact with eating, with inflation, probably a $2 cup o' noodles, right? Styrofoam, you know the one.
Yeah.
Insert
Yep.
hot water. Like we all ate them in college, right?
Yeah.
Um, if you don't know what that baseline number is, you'll never really judge all of the potential opportunities in front of you the right way. So you kind of have to be thinking about, okay, I don't need to make a six-figure salary, but I need to make this ramen noodles number. And or you can call it your cup of noodles number. I don't care. But like just understanding like there's a great high water line where you want to be, and then there's the where you can't go below personally. And that's one way of thinking about risk. And for some people, they're very adverse to debt risk. Like they just don't like debt. It's a personal preference. But if that is your preference and that's what's informing your risk basis, then that's going to color the way that you look at an equity partner because you're going to be way more into that than you would debt. It's going to skew your perception and not wrong, just facts, and you're
Yep.
right. I don't think you don't need it all up front. Like, if you're building 3 restaurants and that's the plan for the next 5 years, sometimes it's a mistake to raise all of that up front because the minute you take money, it always costs something.
Yeah.
If
And
you are
ultimately,
not deploying it quickly enough, like, you're not being efficient with
and
it.
if you're a bad manager of it, the next thing you know, OpEx is starting to eat it up, and that's it,
Mhm,
right? Yeah.
mhm.